The Philippines is a vibrant country with a rich history and culture. Like many nations, it faces economic challenges, one of which is managing its national debt. This debt, simply put, is the total amount of money the government owes to lenders. When this debt rises faster than the country's economy, it creates a problem. Economists use a measure called the debt-to-GDP ratio to understand this relationship. GDP, or gross domestic product, represents the total value of goods and services produced in a country. A high debt-to-GDP ratio suggests that a country might struggle to repay its debts, potentially leading to economic instability. This essay will delve into the Philippines' experience with its debt-to-GDP ratio. We'll explore the historical context, the impact of recent global events, the causes of rising debt, and most importantly, the solutions and strategies to bring it under control. Understanding this complex issue is crucial for informed citizens and policymakers alike. By exploring the challenges and potential solutions, we can work towards a more stable and prosperous economic future for the Philippines. To understand the Philippines' current debt situation, it's important to look back at its history. In the 1980s, the country faced a severe debt crisis. This crisis was triggered by a combination of factors, including high global interest rates, a decline in commodity prices, and internal economic mismanagement. The Philippines found itself heavily indebted, struggling to repay its loans and facing economic hardship. However, the Philippines showed resilience. Through policy reforms, fiscal discipline, and support from international institutions, the country gradually overcame the crisis. By the early 2010s, the Philippines had made significant progress in managing its debt. The debt-to-GDP ratio had decreased and the economy had stabilized. This period demonstrated the country's ability to learn from its past and implement sound economic policies. Just as the Philippines was making headway in managing its debt, the COVID-19 pandemic hit the world in 2020. This unprecedented global health crisis had a profound impact on economies worldwide, and the Philippines was no exception. Lockdowns and disruptions to businesses led to a sharp economic downturn. The pandemic forced the Philippine government to increase spending on healthcare, social assistance, and economic stimulus measures to support businesses and citizens. This necessary spending, coupled with lower tax revenues due to the economic slowdown, led to a significant increase in the country's debt-to-GDP ratio. Section 4. Unpacking the debt burden: key drivers of the rise. While the pandemic undoubtedly exacerbated the Philippines' debt situation, it's crucial to recognize the underlying factors contributing to the rising debt-to-GDP ratio. One key driver is the country's infrastructure gap. The Philippines needs significant investments in roads, bridges, airports, and other infrastructure to support economic growth. These investments often require substantial borrowing, adding to the national debt. Another factor is the country's vulnerability to natural disasters. The Philippines is located in a disaster-prone region and frequently experiences typhoons, earthquakes, and volcanic eruptions. These disasters necessitate significant government spending on relief, rehabilitation, and reconstruction efforts, further straining the national budget. Furthermore, inefficiencies in tax collection and public spending also play a role in the rising debt. Addressing these issues is critical to ensure that the government has adequate resources to fund its programs and services without relying excessively on borrowing. Section 5. High debt, high-stakes risks and implications. A high debt-to-GDP ratio poses significant risks to the Philippine economy. One primary concern is the risk of a sovereign debt crisis. If the debt burden becomes unsustainable, investors may lose confidence in the government's ability to repay its debts. This could lead to higher borrowing costs, making it even more difficult for the government to manage its finances. Moreover, a high debt burden can stifle economic growth. When a significant portion of government revenue is allocated to debt servicing, it leaves less funding available for crucial investments in education, healthcare, and infrastructure. This can hinder long-term economic development and reduce the country's competitiveness. Furthermore, a high debt-to-GDP ratio can limit the government's ability to respond effectively to future economic shocks. Whether it's another pandemic, a natural disaster, or a global financial crisis, a heavily indebted government will have less fiscal space to implement counter-cyclical measures and mitigate the impact on its citizens. Section 6. Charting a sustainable course, solutions and strategies. Addressing the Philippines' debt challenge requires a multi-pronged approach that focuses on both short-term debt management and long-term structural reforms. One crucial step is to enhance revenue collection. This involves improving tax administration, broadening the tax base, and minimizing tax evasion. By collecting more revenue, the government can reduce its reliance on borrowing and create more fiscal space for essential spending. Another vital aspect is prudent fiscal management. This entails prioritizing spending on high-impact programs, improving budget transparency and accountability, and controlling wasteful expenditures. By spending public funds more efficiently, the government can maximize the impact of its investments and reduce the need for excessive borrowing. Debt refinancing is another tool that can help manage the debt burden. This involves replacing existing debt with new debt at lower interest rates or longer repayment periods. Refinancing can reduce debt servicing costs, freeing up resources for other priorities. Finally, structural reforms are essential to address the root causes of the rising debt. This includes investing in infrastructure to attract investments and boost economic growth, strengthening disaster preparedness and resilience to mitigate the economic impact of natural calamities, and improving governance and transparency to create a more conducive environment for sustainable development. Section 7. A call to action, safeguarding the Philippines' economic future. The Philippines' rising debt-to-GDP ratio is a complex issue with no easy solutions. However, by understanding the historical context, the underlying causes, and the potential consequences, policymakers and citizens alike can work together to address this challenge. Through a combination of sound fiscal management, enhanced revenue collection, strategic debt refinancing, and sustained structural reforms, the Philippines can chart a course toward a more stable and prosperous economic future. The task ahead requires careful planning, effective implementation, and a commitment to transparency and accountability. By embracing these principles, the Philippines can ensure that its debt remains manageable and that its economy continues to grow and thrive for generations to come.